Hello friends, I welcome you all in one more knowledgeable interesting video. Today in this video we are going to talk about section 5627B amendment proposed in Finance Bill 2023. Taxation that attracts under section 5627B, also known as angel taxation, right? It is applicable on a company, Indian company, right, a private limited company, when issuing shares to the resident, right? I am explaining you the current position, unamended position of the section 5627B. When Indian company accepts any investment and issue equity shares to the resident, and when the amount received against those equity shares is in excess of fair market value of the shares, then that excess amount is taxable under section 5627B under income from other sources, right? That is taxable as income from other sources. Clear? Now, what is the valuation principle that has been also clarified under income tax rules? There are two methods that has been proposed for valuation. First is net asset method and second is discounted cash flow method. This method is widely used and it is also internationally recognized. For net asset method, you can obtain certificate either from a chartered accountant or from merchant banker. But for discounted cash flow method, certificate from a chartered accountant is not allowed. You have to obtain valuation certificates from merchant banker only if the valuation is as per discounted cash flow method, right? So this is the gist. But this section also excludes a category of specified entities on which section 5627B is not applicable, right? Lot of litigation arises because of this 5627B, and because of that litigation, the startups, right? Startups entities were facing lot of notices, were facing huge litigation, right? And their maximum investment goes to the income tax department in the form of taxation, in the form of outgo as taxes, right? So the investors has gradually stopped investing in Indian startups. So this law has been changed and some specified entities has been now in the section on which section 5627B is not applicable, right? Startup is an entity on which 5627B is not applicable, but startup has to satisfy some conditions. First is that it has to be recognized startup from DPIIT, right? Second is that the total of share capital and premium should not exceed rupees 25 crore, right? Third is this startup should not invest in some assets which are listed in the notification, right? So startup, or which can also be known as the specified entities on which section 5627B is not applicable, right? So this is the gist of section 5627B, the existing position. Now what is the amendment? Which is proposed? Right. Amendment that is proposed is Indian company who is not a startup, right, when accepts amount as capital from non-resident, right, then section 5627B is applicable on this company if this company accepts the amount of capital which is in excess of fair market value of shares, right? So this is the amendment that has been proposed, and it is very much clear that when a non-resident invests in a startup, then also section 5627B is not applicable. It is not applicable. Earlier specified entities were exempt. In the proposed amendment, it has been also now kept as exempt entities. So non-resident can very well invest into startups Section 5627B will not going to be applicable. But the company which is not a startup, a big company whose share capital is more than 25 crores, right? Then that company is not falling the category of specified entities. In this company, if non-resident invest and the amount is in excess of fair market value of the shares, then that company have to pay taxes on the difference amount under section 5627B as income from other sources, right? So this is the amendment that has been proposed in the Finance Bill 2023, a very interesting, very important amendment, especially for the non-residents who is looking for to invest in the Indian startups, especially for the companies who are the startups and seeking or attracting investments from the non-residents, right? So this is very important discussion, very important video relevant for these category of taxpayers, right? Now, one last point, a small point that we also like to discuss here is that applicability of TP provisions, right? That whether the TP provisions are applicable or not in such transactions. When an Indian company attract any share capital, when a non-resident, right, buy share capital of an Indian company, then TP provisions is applicable or not. This is also highly debatable issue. This is also highly litigative issue, right? In the Income Tax Act, Taxpayers SSC says that there is no specific provision in the TPE law, so this transaction should not fall or cover into the TP adjustments, right? So because of that, right, we have one CBDT instructions as well as one landmark ruling of Bombay High Court in the case of Vodafone India Services, right? In this judgment, Bombay High Court held that law does not contain any specific provision, TP law does not contain any specific provision to make TP adjustment on such transactions where non-resident is investing money as a share capital in an Indian company, right? So TP adjustment is not allowed. And after this judgment, CBDT also issued one instruction number 2/2015. In these instructions, CBDT also said that we need to honor the judgment of Vodafone India Services, and it is instructed to all the officers, all the departmental officers, that TP adjustment should not be made in the capital transactions. When an Indian company attract capital from non-resident, then TP transactions are not applicable in this case, right? So section 5627B, if taxation falls within 5627B, then tax has to be paid in income from other sources, right? Then the dual taxability cannot be made under the TP provisions, right? By applying any of the valuation principle as mentioned in the TP provision. So this transaction, whenever any non-resident invest in the Indian company, which is in excess of fair market value of the shares, then TP provisions are not applicable in this transaction. So we have discussed here amendment proposed in section 5627B, annual taxation. Amendment attract when non-resident invest as a share capital amount in the Indian company, right? The Indian company is not a startup, right? And what is taxable? Taxable amount is the amount which is in excess of fair market value of the shares, which is taxable as income from other sources of that company who is getting share capital from the non-resident. So thank you for watching this video. We'll keep coming with a lot of knowledgeable, interesting videos on this, right? On Income Tax Act. If you have any query relating to this section or any other section of Income Tax Act, then please post your query in the comment box. Subscribe to the channel, like this video. Thank you. Thanks a lot. Bye.